Hey everybody, welcome to another episode of What Ted Says, where it's always time to get a fatter wallet and a bigger net worth. That's what we do. Try to give you some of this scoop to help you do better with your money. So, I want to do some teaching things here on What Ted Says. And so I often get this question of what is a CD and how does it work? Remember in the past, CD used to stand for crummy deal. Now, well, it always did, stands for Certificate of Deposit. These are things that you will do with banking type companies. So just what is a CD? Because sometimes you see this on websites or you see it in a local paper, but really a CD is nothing more than you loaning your money to a bank for a fixed period of time to get a fixed interest rate. Sometimes CDs can be as short as 30 days, 30, and they can go as long as 5 years, depending upon the bank. And normally, the longer that you tie your money up, the better of an interest rate you're going to get. Hasn't always been true in today's world, but generally speaking, it's true. CDs generally, in general, they'll offer a better rate than you can get in a savings or a money market account. This is why we'll do another What Ted Says video on how to ladder your cash. Many people have money in a checking account or a savings account, but they don't ladder their cash to get their actual cash to be FDIC insured and work harder for them. First question, are CDs a safe investment? The answer is YES. CDs I would generally consider to be amongst the safest investments because you're guaranteeing your principal. There is really no risk of losing your money at all unless you pull your money out early and you may pay a small penalty. So this is different than investing in bonds and different than investing in stocks. Why? Because you're getting a guaranteed rate of interest. So if you loan $10,000 to the bank and you do a 1-year CD, you may get 4.5% interest rate. That's the terms. So in this case, you'd earn $450 of interest. The bank may say if you pull the CD early, you'll have to pay a 90-day interest penalty, which means your interest can be lower. So you want to make sure that you can lock the money up for the period that you agree to lock the money up. But just keeping your money in a savings account or a checking account that sometimes you don't touch for years is a really bad idea because you're just going to make less money on your money. Now, I want to remind you that all CDs are not created equal. So it's really important to look at the kind of CD that it's going to be. Some CDs that are out there are called high yield CDs. So you'll see this often with high yield savings account, which is just a way to say that you're going to make a better interest than you would make on a normal CD. Why wouldn't I do it? Well, you would. They're typically available in most online banks is where you'll see it. Every once in a while you'll see it in a local bank. That's the way that the online banks that will compete out there for your money. So you can see big banks like Ally Bank or EverBank or other banks like that may offer you, CIT Bank is one that may offer you a better deal. There are IRA CDs. A lot of people don't know this, but you can put a CD, dunk, right into your IRA. So if you said, boy, I want my IRA to earn a guaranteed rate of return, I don't want to lose any money, I want to make sure my principal is safe, and I want it to be FDIC insured, your only answer isn't a money market account. This is where, in another What Ted Says video, we'll talk about laddering. So CDs can absolutely be bought in an IRA, and they can be bought in a Roth IRA. There are CDs called jumbo CDs. Jumbo. The jumbo CD that's out there really means that you're going to get a better interest rate because it requires a large minimum deposit. Sometimes that's $50,000. Sometimes it's $100,000. It could be $250,000. But if you were going to buy a home in a year from now and you knew you didn't need the money for a year and you had money from your old home, you could open up a jumbo CD. It's a great way to make the most amount of interest on a guaranteed basis that you can make on some type of short-term investment. So these are all reasons and things to look at when you look at different kinds of CDs. Let me just give you a quick pro-con on this about why you may be looking at CDs. So what are the advantages of CDs? Generally, you're going to get a higher interest rate than your savings account. you will always get a higher interest rate than you're getting on your checking account. Often your checking account is earning zero. Unless you basically bitch to your bank, you're generally not going to make that much on your savings account. Safety, they're FDIC insured. I have another What Ted Says video here on FDIC insurance. I recommend that you check that out. We're not going to get into it, but they are FDIC insured. You get a predictable return. When interest rates are higher, people loved CDs back in the 80s and 90s because they were making 10%. You're not going to get that today, but they're really low to no risk. You only really have inflation risk, if you will, but you get a predictable return. So let me give you one example about how this would look. So when you want something that's predictable, if you basically take an investment, let's just say it's going to be $10,000. And again, I'll use an example where you get a 1-year CD and the interest rate is going to be 2.25%. So if you put $10,000 in and you wait one full fiscal year before it matures and everything compounds, you will have $10,225. Typically, the bank, about 30 days before your CD comes due, will ask you if you want automatic renewal. And if you do, it will just automatically renew and go into another 1-year CD, which is why you need to pay attention to it. By the way, in that example that I gave you, the APY, if it's 2.28, it would be $10,228. I know it's only a couple of dollars, but this is you can look at it. Really, in the end, there aren't that many downsides of using a CD. Obviously, you have it locked up, so if you buy a 5-year CD, you could pay a significant withdrawal penalty if you want to take your money early out there. Obviously, do your due diligence on the bank. Make sure the bank is solvent. Of course, you will have FDIC insurance, but you want to do your due diligence on the bank and on the product as a whole. This is how a CD works. So if you're sitting at home and you've got lots of money in a checking account, lots of money in a savings account, but you don't think you're going to touch it, like the rainy day's not going to be here for 6 months or 9 months or a year, maybe it's time for you to look into a CD. That's this episode of What Ted Says. Check out all of my tutorial videos that are on here. You may want to look at the one that I did on What Ted Says about how to start getting invested in stocks. It's very popular. A lot of people like it, and thanks so much for tuning into my channel.